In this interview, I'm talking with Boris Katsnelson, an investment banker and a managing director at Black Iron Advisors. He brings 20 years of experience across investment banking, private equity, and his own business ownership. So he understands both sides of the deal. We talk about why the right investment banker doesn't just help you sell your business, they change the game. Boris acts as both a strategist and an emotional buffer, guiding owners through what's often the biggest and the most personal deal of their life. We cover when to bring in a banker, how to create real leverage, what mistakes to avoid, and how to walk away with a deal that truly supports what's next for you. Boris, thanks so much for being here. We are talking today about selling a business, and you are an investment banker, and I know you do much more than that. But in the context of that, can you just lay the foundation for this conversation and talk about what the role of an investment banker is in a sale?
Absolutely. And thanks so much for having me. I'm honored to be a guest of yours. And so an investment banker, really to think of us as kind of the strategy architect for a deal, right? It's the process, it's the structuring, the positioning, which we'll get into much more than price or what we sell in the business. So we orchestrate, think of us as kind of the quarterback for an entire deal team. We also, a big part of that is manage a lot of the emotional parts that I bet we'll get into in this conversation. Someone selling their business, we've done it dozens of times, but the seller typically does it once. They've built a business that's their baby. And there's a lot of emotion involved. I'd say literally every single time. And we are a lot of that buffer, and that's a big part of it. And allow the seller to really run that business, because it's really important to do that, run it all the way through close. We tell our clients, pretend you're not selling, keep running the business, keep making decisions as if you're not selling the business. That's really, really important. And when we run that process, which we'll talk about more, is creating that leverage with buyers and making sure we get the best outcome. Yeah, that's kind of the main thing, is just we soup to nuts kind of run that process, and happy to, dive in more on what that all entails.
Yeah, let's do that. Let's actually, because again, like you said, a lot of people, there are some serial entrepreneurs out there selling businesses multiple times, but many times it's something you do only one time. So could you walk us through, is the deal size matter? Does the complexity matter? When does a owner engage you? And then what are the steps that you go through at a high level?
Yeah, we really like to get engaged with owners early in a process. So early in their life cycle, as they think about a sale, if maybe even a few years out from it, because there's a lot of preparation that can be made. There's tax efficiencies that can be done ahead of time. There's making sure that the team is structured accordingly, and that the transition once they sell the business is the right one. We sell businesses that kind of two camps, one on the smaller end to individuals, where an owner will typically transition out very quickly, or most of the deals we do are to private equity, where they're going to typically stay on maybe for longer as part of that team. So we're doing that preparation work is really part one. And that entails helping assembling the full team, including, in a perfect world, someone like you with the skills that you do at Interwovenly, making sure we clean up the data and the financials are really clear. And kind of the work that you do too is like understand the seller's goals. We always ask, what do the next 3 to 5 years look like for you? Now, we don't get into the kind of emotional part that maybe you can touch on, but that prep is, we've been collaborating with some clients now recently, understanding their goals post-close. A lot of times, owners will come to us, and when it's almost too late, we tell them, sell the business when you've still got 3 or 5 years left to maximize value. Now, the buyer may not require you to stick around for that long, but it's always good for us as your advisor, investment banker, to say our client is excited to stay around for a long haul. So preparation is one. And then once we get going with the process, we prepare what's called a confidential information memorandum and a no names teaser that goes out to interested parties that doesn't identify the business. And then we do the marketing for it, right? So that entails really customizing that buyer list is really important, right? We're not doing, it's more sniper shot is the way we think about it, versus shotgun approach where you spray and pray. Like, we know exactly what private equity groups are looking for, this type of asset, and we go to them, and we basically don't relent until we get an answer that either yes or no, but we just want to get an answer, right? So we make sure we run a really broad process. And then it goes to, we call it a 2-step process. It goes to an indication of interest. Once we've talked to buyers, then they put a non-binding indication of interest, or IOI, together. And then we sort through those and talk to our client about it. when we get to a letter of intent with certain parties, and then we select one. And then sort of part of that process, they're meeting with the management team to get assessed before the LOI. It's kind of in between that IOI and LOI. And then we're working towards negotiating with the parties to get the best deal for our client. And we sign exclusivity with one party typically and get them to the finish line to close, which is navigating due diligence, legal documentation, all the things that are involved in it. And it's a lot, and there's a lot of components to it. And, it's preparation is really key. That's why starting early is really important. But that's really the process, really. It's preparation, marketing, kind of running the process, if you will, negotiating, and then ultimately getting to close and getting to the outcome. And a lot of times that deal is quite different than someone going in expects, right? We have clients coming in saying, oh, I just want 100% sale of this business. I want to wash my hands of it. I'm done. And then through the process, we unearth different outcomes for them. And that's really kind of the fun part of our job, is to run that process, go to the potential interested parties, and you can't predict exactly what it's going to look like, but usually our clients are pretty happy with kind of how it all transpires.
That's great. So talk about a little bit about deals, like where does it make sense for, like, how big does your business need to be to start a conversation with you, or the complexity? What kind of complexity would a business owner want be like help?
Well, I would tell you, at any type of transaction, it's helpful to involve an investment banker or on the smaller end, a business broker, just because there's expertise there. All the things we talked about with the seller focused on running their business. What we tell our clients, and it's pretty much been 100%, that we want to pay for ourselves through that transaction. And that's in terms of, pure dollars, right? So, client we just closed a week and a half ago. They paid for themselves and then some with where he thought it was going to transact. And that's running a competitive process, and you continue to run the business. So we to talk to owners, really to be a service to anybody. We tend to find, even if they're not a great fit for us, which does happen, we can refer them to other people, and business owners tend to know other business owners in our minds. So we don't view that as a waste of time by any means. So would certainly welcome your audience to reach out to us. Our sweet spot, though, I would say, is 1 to 7 million of cash flow. That really is kind of depends on 5 to 50 million of revenue. We can swing above that as well, especially in core industries that we know really well. I myself have been an operator in a few different sectors in franchising, both a franchisor and franchisee, trades, and consumer products. So I tend to focus my efforts. Those are big enough sectors, and I've got some subject matter expertise. But as a firm, we're generalists. We've also done outdoor hospitality. We've done quick lube, oil change places. We've done testing, compliance. You name it, we've probably touched it. But those are a couple sectors that I personally kind of engage in. So punchline is, anybody that's a business owner that wants to just learn a little bit, we're happy to be helpful.
Yeah. And just a side comment on that is actually a genuine comment from you that as we've sat down and talked before, I think a business owner thinks that investment bankers are just all about the money, like sign and get it sold, right? And what I really appreciate about you is the willingness to talk to anybody, to say we're the fit, we're not the fit, to develop the relationship over time. So I think that's, maybe we'll get into misconceptions a little bit later, but just as you're speaking about that, just something I've noticed. As business owners are running the business, right, heads down, and maybe they're thinking about selling in the back of their mind, but they haven't really put it out there quite yet. And suddenly an unsolicited offer comes in. They have that first conversation and they go, okay, maybe I'm interested. Now I need some help. What are some of the costliest mistakes that they make in that first conversation? And how can you, as the investment banker, sort of unwind that and influence the deal from there?
Yeah, I think first, what happens a lot where we get tapped on the shoulder to say, hey, someone so approached me, I like them as a buyer, and I want to go do the deal. And ideally, we kind of catch that beforehand, because almost every time I see someone submit financial statements, which is usually what happens, they're not the way we would present them. And typically they're kind of understating their EBITDA, which is, earnings before interest, taxes, depreciation, and amortization, which is finance talk, but essentially how much money do you make in cash flow a year? And a lot of and as business owners, folks tend to run some non-business oriented expenses through that business. We want to make sure we add all of that back to be a true representation of the business. We like to catch it before that's sent over, because buyers, it's hard to unsee something that, if someone we present something at 4 million of EBITDA before we get involved, but it's really 4.5, which is exact situation that I found, you got to sort of walk that back, and it's just better when you don't do that. So we've had another client who was like, hey, I've got outreach by 2 groups. We want to, explore these. And we say, yeah, let's take a look at the numbers and structured it how we would. And the intent there is probably we do run a process for them fully. And sort of to your point about we may end up selling to one of those buyers if they hit kind of the bid and they've got a bit of a head start, but we always want to maintain leverage through a transaction, and not to say, hey, you're the only game in town, which anything you would expect that you may not get the best deal if you feel the buyer has all the leverage. So ultimately it's got to be a win-win. So the mistakes, I'd say, to answer your question, is you get sort of lowballed either on price or terms. Our founder, Blake Nielsen, likes to say, hey, if someone says I'm getting $1 billion, but I'm getting $1 a day or $1 a year for 1 billion years, that's a terrible deal, right? So you want to make sure that you're getting a really good structured deal. So I think the other part is with unsolicited offers, just kind of a little bit of an ode to you, is understanding what do they really want in your practice as I know it, rather than being emotionally prepared. Maybe you can speak to that because I think it's super relevant.
Yeah, I guess if they start into the deal and deal is done, what I've seen, if they're not thinking about post-sale, their legacy, and really thinking about what that is. I mean, you mentioned tax strategy earlier too. There's all kinds of charitable and tax things that are in there. But then to your point, what is the lifestyle that you want afterward? Does an incremental payment make sense? Does a lump sum make sense? Like, what is it that you want to do? And what is that lifestyle really specifically? I think a lot of people think, well, I'm going to golf and take some vacations, go travel, right? And take some time off. But as business owners, that doesn't last too long usually.
Right.
But for many, I get them when they're in sort of a bad place, when you're like, okay, let's go dig you out of this hole post sale, because you didn't think about that ahead of time. So yeah, I would definitely say that's a costly mistake on the emotional side. That I love that you guys address too. You're the emotions of the sale, right? It's this price, it's not that price. They're interested, they're not interested. All the ups and downs of the sale price, and asking them what's next. But really knowing what they're selling to go to, what's next is important, I think.
Yeah, absolutely. Yeah. No, totally.
Yeah. So talk a little bit, certainly before I started talking to investment bankers, I had Gordon Gekko and corporate raiders in my mind, right? Big bad investment bankers. Talk a little bit about the misconceptions that you run into, like even going back to you get an unsolicited offer and you try to do as much as you can until you realize, oops, maybe I need some help. How that misconception plays into that. I should have got the offer and called you right away, right? Yeah.
Well, and I think that's probably the biggest one is, well, we already have a buyer, we're good. Right. But the amount of work it takes from just someone submitting an offer to getting to close is a ton. Right. And there's a lot of nuances to it. And I think the biggest thing to remember, especially when you're dealing with private equity firms, is they are professional buyers. Just we're professional sellers of businesses. That's what they do. Right. So the person who built an amazing HVAC company, the 4 million of EBITDA, they're not so good at selling an HVAC company. They're good at selling those services and getting contracts and all the things, but it's a pretty different process, right? So there's so many little nuances to a deal and the dynamics and the emotions, all the things. And so that's where I think a misconception is we're good. And we will tell people quite honestly, if they genuinely have the perfect buyer and they can use this as a resource, and we say it genuinely, and they hire a great M&A attorney, they may not need an investment banker. This is the perfect firm. We'll tell them to buy it and overpay a bit for a lawyer to make sure they've done a lot of M&A and they can really support it. Then you may not, but it's typically very helpful, and we're happy to be helpful in that. I think the other thing is people say that they only care about price, and there's so much more to a deal than price. The terms, how long do you have to stick around? Are there any earnouts that are contingent on the performance of the business, all these things. And ultimately, where we shine in this is that our biggest referral source, as you might expect, is actually other clients, right? I just was really blessed to have 2 referrals from the business we just sold a week ago, right? So those, you can imagine what those prospects are thinking if, hey, we just help sell this one's business and all that. So we don't care about price. We want to make sure it's a great outcome. So sellers continue to refer us. If we're just trying to jam a price down someone's throat, it's a short-sighted game, and we don't play that. The other part is that they're too small is another one that I think about, right? And I think anybody that is doing any kind of transaction, there's value in having somebody look at it, at least, like I said, with an open offer to anybody is, if they're contemplating it. I had a friend and business referral partner of mine refer me someone in the HVAC space. That's why I mentioned it kind of earlier. Yeah. They just this morning I talked to that founder and we talked through some situations there and trying to be helpful. I don't know that it was a little bit on the smaller end for us, but it doesn't matter. Again, we want to be helpful. And so, yeah, those are kind of the main points I'd say.
Yeah. Do you have an example of a client, and you don't need to use names by any means, but where they maybe started or were on the wrong track and you were able to come in and really provide that guidance and shift the whole process to have the better outcomes to find the outcomes that they want, not just sell the business, but to really make a difference to them?
Yeah, I'd say one example, again, yeah, no names basis just for
Yeah.
confidentiality.
Yeah.
It was that same example we've been talking about with an unsolicited buyer came in and they were excited about that party, but we said, let's go run a process here and make sure that it is in fact the best offer. And sure enough, we had multiple parties come to the table and create a better structure than that initial person did. That first group did pop up their offer because, again, all the things we've been talking about, competition and leverage helps.
Yeah.
And that sort of creative leverage and tension in a deal is important. And yeah, we bettered it, and we got them to, not have contingent compensation. It was all cash at close. So it was a very different outcome, a better outcome for that client. And, we often have, we'll do certain things like if a client comes to us and said, hey, we got this unsolicited offer, would you give us a lower fee if we close with one of those parties? Because I found them. And we do that all the time. And we're happy
Okay.
to, because that's part of the job, but still a big part of it is getting to close, as we talked to earlier. But the odds of that person coming through and being the one is not really that high to begin with. If it is, cheers, it's great. We're happy to get that deal to the finish line. But it's got to be, seller will really quickly figure out that it is either is the best deal or it's not, and we can help guide them. But it's having those options, I think, are really important, and that's what running even a modified process is helpful.
So I'm going to throw you a curveball question. Are buyers
Sure.
in that case like, oh man, an investment banker got involved because now I have to deal, do a more difficult deal, or they've got
They're not
leverage, they know
happy
the
to hear
deal.
from us. Yeah, they're not thrilled about it. That first
Yeah.
conversation when the entrepreneur introduces us to the party, they're like, oh, but they get
Oh,
over it pretty quickly because they like the asset. But the dream of,
yeah.
and I've been on that side of it as a private equity investor, the dream is this proprietary deal, meaning no one else is looking at it. No one like me is
Yeah.
sitting there representing the client.
And
That's a dream. So
hey.
they're not, they
Yeah.
don't love it when we get introduced. You're spot on about that, but they're big boys and girls and they get over it. And if they like the company, they'll ultimately,
Yeah.
it's an efficient market at the end of the day. And they get that. And, I think the right private equity buyers, I would tell you, actually look at it and embrace folks like us to come through to a deal because we can streamline the process. We make it efficient. We deal with a lot of the emotions that kind of go into the deal as well. Does it mean maybe a little bit higher price? But I think private equity in general, the good firms aren't trying to steal companies truly. They're happy to pay a fair price for a deal. And then, their value is in growing it and scaling it and adding on different other businesses and getting it to the next tier of size and then ultimately exiting there. So yeah, but it's a good observation and you're spot on about it.
Sorry, buyers.
Yeah.
So just, can you talk a little bit more? Let's dive in deeper, especially I think this seems to be with your connections, how you create the leverage and that competitive tension that we just talked about, the first buyer, especially not enjoying that competitive process, and how do you, when you have enough tension in the deal or too much tension in the deal, how do you weed those out for a business owner? And I'm sure a lot of it depends, but just talk about how you think about getting the best buyer and the best deal at the table for the seller.
Yeah, I mean, it's an art as much as it is science, right? And understanding that those dynamics of who wants it more. And frankly, we talk about it internally a lot with just, do we have enough interested parties that we've sort of spent enough time with that would, when we put out a process letter. So in that marketing phase, we talked about that indication of interest or IOI. Before we call for that deadline, right? It's like, you want to make sure people are going to show up to the dance effectively if you're going to have it. So we want to make sure that we've got enough strong people that are going to, show up and that have an interest in it. And then we want to get at that anywhere between, call it at least a half dozen, but ideally a bit more, depending on the dynamics of the deal. I like to always kind of feel really good about 10 or so bidders that are going to be showing up. And then you'll be surprised, some that you thought were slam dunks that would would submit an offer don't, and others you were like, no, they were out of the deal, still choose to submit an offer, right? So even though you just don't know how buyer behavior is going to be, but that's where that
Mm-hmm.
dynamic happens, where we've got, call it 10 parties that submit offers, and that's where in that marketing phase we're talking that sniper shot into buyers. We know that they're buying this type of asset, and then we're making sure that we're educating them. We're providing any other materials that they need beyond what we prepared. Which, just to give folks a little bit glimpse of that confidential information memorandum with us and the detail that we put in, it's incredibly comprehensive, talking about anything and everything about the business that would be relevant about it, from the terms of leases to detailed in the financials, what kind of owner expenses are running through it, how the business works, what the staffing looks like. And ultimately, that ends up being a 50 to 100 page PowerPoint deck
Mm-hmm.
that's dense, really dense, with a lot of information and all that. So people can have, when they're bidding, they ask us a lot of questions, but they're submitting offers. They're pretty well up to speed on the business and have asked us a ton of questions, and still having not spoken to the owner at all at this point, right? That only happens after IOIs. We have buyers all the time trying to say, oh, I want to talk to the owners. And
Uh-huh.
there's a rare instance where we may say, okay, if you want to try to what's called preempt the process, right? So just get ahead of everybody, it would have to be kind of a order of magnitude higher price than we're expecting. And
Mm-hmm.
that does happen, where someone's like, hey, I'm building an HVAC platform and I'm missing something in the Front Range of Colorado, for instance, and our client is a perfect fit for that, where they may say that, I
Yeah.
understand the market's maybe at 7x or 8x. I'm willing to pay a couple of turns above that, or a couple multiples above that. And we'd say, okay, submit your offer and we'll talk to our clients about it. But that, it does happen. I don't know percentage wise, but it definitely happens. But at the end of the day, I think I have to have our clients see the field of offers and all that. So
Yeah.
there's select situations where we would do that. But the big thing is buyer behavior really improves when they know they're not the only one. That's kind of
Yeah.
a big punchline, I would say, which I think people can resonate with.
Totally. Another thing that sort of is a common thing, at least I hear it a lot from owners who selling, there's a gap between valuation, right? So I've built this business. I've spent my whole life, or 10 years or whatever, building my baby, and I think it's worth this much. And a buyer comes in and says, I don't think it's worth that high. Talk about what drives that gap between the seller and the buyer, and how do you manage it? I think that's where your psychology probably comes in a lot, right?
Yeah. It definitely, and I'll tell you, I think, just again, so a little bit to you, what the work you do, in my experience, right? Kind of decoupling that, their identity from price. I think
Yes.
that understanding and what do they want to do, and financial advisors become part of the team as well, to help us think about, okay, what do I really need? If this is, a lot of our clients are in their 60s where this is it, they're done after this transaction, but making sure that their clarity on what's next, per our earlier conversation. I think the gap then comes that we always hear, sellers say, well, I want $20 million for the business. Well, buyers are rational and they know markets for a certain asset are going to trade at whatever the number is. And usually we've said multiples, just to clarify for the audience. If you take the EBITDA for a business, say it's $2 million, and say the multiples in this kind of business is say 5, that's $10 million, right? And we can run a process and it'll be a little bit higher. Maybe we can get to 12, something like that, with the right type of buyers that are interested, but it's not going to be 20. Right. So if someone's got 20 in their mind, we also are pretty big at screening and getting that alignment with our clients on the front end of it. Ultimately, we have a really good sense of where the market clearing price, if you will, for an asset. And so we like to align with our clients. I'd say one other thing that's kind of different about our model is that we don't charge retainers either. So we get paid only if a deal happens. Big part of, in my example, of we can get maybe 10 to 12, but the seller's thinking I need 20 and I'm a seller only at 20. We'll just bow out of that deal. We'll say, look, we wish you the best,
We
but
can't
we're
make
not
that
the
deal.
right fit for you.
Yeah.
Because it's not reality. And I think people will really understand and get it. And if they want to hire you, but you just say, look, this is just, you got to decouple that, right? So I think that's a big part of it. I think we just try to be non-emotional about it and just dictate with logic. Here's why we think that the multiples in the 5 to 6 range versus you're thinking 10. And it's, in our professional experience, that's not likely. So I think that's a big part, is market realities is key.
Yeah. Do most come around? Do you find that most are like, okay, a little disappointed, but come around? Yeah.
Yeah.
Something else I've heard you say too that I thought was really insightful, maybe obvious but insightful, I don't think of it this way, is that buyers look at the past, right? They're like looking at what they've built, their legacy, and
Yes.
buyers looking forward, I think is the quote you, or the, like, how you look at that. Correct me if I'm wrong, but that
I
would
mean,
obviously make some tension there.
yeah, I mean, it's a mix because if you think about it, the seller created the value up through closing date. The buyer is looking at valuing the business as of what happened in the last 12 months, so we call it LTM, last 12 months. That's where kind of, when I say multiples, it's usually off of that number, but ultimately the buyer is, that history is important to value what the business is. For instance, if you have a big contract that drove that, a lot of that performance, but it's not going to continue on, then that business didn't matter that it did what it did through the last 12 months, of the period before I'm buying it. So there's a substantial amount of due diligence that people do to make sure that, it's what is it going forward, and can they influence it as buyers to get, but they're really, most buyers, as we think about it, are looking for stability of the business. And if there's, in the example of a big contract, kind of going away, then, they'll value the business accordingly on what that, sort of the pro forma business looks like.
Yeah. That's good. So, and we talked about it a little bit here, preparing early is better. And anybody listening to any of my interviews that I do here will also hear me say sooner the better, right? Whether it's the work I'm doing with them to plan for what's next, or getting ready for a sale, getting your books in order, all the things, right? But let's talk about a year after. Talk about, I mean, there's so many ways a sale can come to fruition, right? You can just get the lump sum, you can have a buyout, you can stay on, you can leave. Talk about how you guide, or how you feel a year later, you're talking to your clients and they're like, I'm still so happy. How did you help them define that, outcome that a year later, they're like, that was the best deal? Or even, 2 weeks later, and they're referring you to other people where it's, this is going to support me in what I want.
Yeah, I think the collaborative aspect, honestly, with the work you do is really powerful, I would say, in this regard, right? So to understand, like, what does that next chapter look like so that they can truly be happy. Like, we do a little bit of that, but truth be told, like, that's not our core focus, right? That's where like we can collaborate with clients, is to really understand what's next, I think is really, really important.
Yeah.
What are they really looking for, I think, is really key. So some people do want to stay on and grow and, and be part of the organization, just take some chips off the table, but roll equity. Others, like my client, didn't want any kind of continuing involvement beyond a little bit of a transition, but he did want to transition and transition well. So he's available to the next owner for 6 months, and he wants to do consulting for other businesses, including this one. He was a franchisee. So he wants to consult with others in the network, and that was important to him. And so he's going to be doing that on a go-forward basis. So I anticipate, he's ecstatic. In the referral email he just made, he said he called me his hero in all capital letters. So that felt really good.
That's amazing. That's awesome. That feels good at the end of the day, right? Yeah,
Absolutely.
I know. I was just thinking about that. I had one owner, there was a couple of partners in the deal, and after they sold, they were all going to be out, right? They were sailing off into the sunset. And what ended up happening is one of the partners couldn't let go, the main partner who had kind of started it, and had the opportunity to go back in the office, but it wasn't really necessary, and suddenly was there all the time. It was like back to the full-time job. And that was a big identity piece, right? That was, they were all partners. They'd all built it, but it started with him, and he was having a hard time letting it go. So I had to work through some of those identity pieces. But I always say in the earlier, and often it's when you're doing the business, when you are the CEO of something, it's easier to try and do things, experiment with things when you're already the CEO and not the former, right? Not the former something. So there's a lot of experimentation that can go on, which is great to do even before you do the sale, because there's so much that goes into the sale process, right? They're heads down on that piece. So yeah, I'm a huge proponent of starting early to figure out what's next. For sure. Yeah. And so I think if you were talking to a business owner today who was not ready to sell right now, but it's on the horizon, what would maybe we've already talked about it, but what's your best advice, or the one key thing they should be doing as they have the selling my business in the back of their mind?
Yeah, I think, it's assembling your kind of team, right? That deal team, if you will, right? With, a lot of times that will include, an investment banker like myself, someone like you that's kind of helping them coach through what's next, what's the next stage, because that emotional piece is powerful, right? We see sellers that are, you see a lot of, I don't know, it's not a great stat, I think, that people that don't plan, but I've heard just anecdotally, like, you don't plan and you don't think about what's next, especially with men who are so tied to the business, which a lot of our clients are men, it turns out. You got to do that planning, right? Stuff. And then, so beyond, like, someone like yourself as a kind of coach, us as investment banker, your tax attorney, your CPA attorney, other, wealth managers. That's kind of
Yeah.
the core team I would think that,
Yeah.
that you would want to have kind of in your corner as you're, contemplating it. And it's important, like we've been talking about, is just, assemble the team early, think about all the tax consequences, think about your future life afterwards. And, and then I think, the other piece is just, we touched on it a bit, but making sure the, your KPIs are sound, getting your
Hmm.
financial house in order, making sure the team is set, make sure there's like redundancies, interdependencies. And we tell a lot of owners, especially if they want to like really transition out or be at a lower, amount of time than they are today, is try to make yourself obsolete in the business where you can be a guest in the business and you're in the owner's box versus you're responsible for the top 5 clients and generating business. Well, all of a sudden you become awfully important to that company, right? And your idea
Yeah.
of kind of going away becomes, much more difficult. So I think that transition is really important. I think, best advice is just have that optionality, right? So you can pull the trigger at any point in time. I think is really key. Emotionally ready. Again, the piece with you, I think the work that you do, that's where, I'm excited about the partnership that
Yeah.
we have in that regard, is just
Yeah.
making sure that you have a better outcome, not only the things that we can deliver financially, but emotionally you're set. Because if you're not happy afterwards, then to what end?
Yeah.
It's not a great outcome, right?
Yeah. 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 What's the life your wealth is building anyway, right? It's not great to
That's
just
right.
go sit somewhere, right? It's bad for our
Absolutely.
human connection. Boris, thank you
Totally.
so much for this conversation. I really appreciate talking about the investment banking process and being available to business owners to, have the questions, get the insights. Any last words? And please let us know how to connect with you. We will certainly link to you as well here. Any last words you want to say? Words of wisdom.
You bet. Yeah, no, I enjoyed the conversation very much. I think the main thing is don't wait to get smart on the process. I think, kind of start early, engage, build that deal team, that you've build trust with. I think is really important to set yourself up for success with all the folks we just talked about. And, I would say I'm here and available truly to be a sounding board, not as a pitch, just purely to offer perspective and guidance in it. And, to that end, I think we'll link to my email address, which is long, but feel free to email me or even shoot me a text. We can put my cell phone in there. I'm very open to anybody reaching out to just visit and see how we can be helpful. It's really an honor to help serve people and see entrepreneurs, thrive on this, kind of final chapter often for a lot of folks. So
Yeah.
yeah, really enjoyed the conversation. And yeah, thanks so much for having me.
Thank you.